I did.
So, welcome to Manchester, New Hampshire. I'm Sandra Stone. I actually drove down with two colleagues from Maine, but Liz asked me to welcome you all. Since I'm very fond and pleased to introduce to you Jean Hammond, who's here to talk to us today about Diligence. She's a very experienced angel investor, has done a lot of training, and has been a great resource to many of us. Even though I've been an angel investor for 10 years, I'm always still learning and looking forward to today. So Jean, thank you for being here. Glad you didn't get much snow, and you didn't get much snow in Maine. So.
Yeah, I think we got off easy this time in New England, so thanks so much for having me here. And you know, my assistant put these skyscrapers on, but that's just to prove that I do know where Boston is, and I live there most of the time. And really, I'm totally excited about the idea that we're starting to work on improving the reach of angel investing into the parts of the country where we need the innovation economy to be really well supported. I went out to a really brief little conference out in Reno where VCs were talking about how can we interact with a blueprint for the non-coast parts of the country, and it just made me realize again how important I think it is that we show people how to bring angel investing into the parts of the country where lots of great businesses are being formed. So I've got a dead tree version of the presentation in front of you, and we can send the slides around too. And then we have a couple of handouts that I'm mostly going to use in the end for us just to ask questions and discuss what's going on. And really, one of the things that always happens in angel investing is people start to talk about, you know, amongst the things that we need to get some training on is this thing called due diligence. It sounds really pompous. And so really, this is really just a chance to dig in some more and think about, well, why are we doing this thing? Why are we looking at these companies this way? And how can we make sure that it helps us both be better as investors and also be more accurate at supporting and growing the companies to greater success? And so this is some of the core areas for sort of angel training. And I tried to point out that the things that are in green, screening and community rules, what should you say at a setting where somebody comes up and says, huh, can I present to your angel group? You know, what is your group's way of doing things? And so those are always, the green items tend to be group specific. And so again, just sort of for you folks to figure out for yourself what they tend to be. Coaching, advising, and how to work as a board member around startups, both those that are invested, those that might be invested in the future, and those that didn't make it. Is always a communication issue and needs to be dealt with. And then many groups get a lot of joy from taking a look at what they've done in their portfolio. So we've talked about deal terms, and we've talked about sort of the whole process of angel investing, and you guys can get to the materials on that. But this session is to spend some time on the diligence process. Oops, let's see it this way. So the process, things to assess, where it fits in. We can talk a little bit about the handouts and get into questions. It's a small group, and we don't have tons of material, so feel free just at any second to ask questions. So the first question is, well, what is this due diligence thing, and does it change the outcomes of our investing? And so it turns out there haven't been very many studies done on it. Even if you look over at venture investing and other parts of the investment community, the studies that have been done are not super conclusive. This study from Wildebeck is probably the biggest one, and this really looked again at angel groups that were doing due diligence and tried to figure out what was the what happened in the outcomes. And again, it's what it is. 86 groups and 539 investors, pretty big, but it's also maybe just a sort of a tip of the iceberg in terms of showing what it means. And anyhow, thousands of angels every year ask their own questions and don't necessarily rely on written materials to decide how to invest. So the basic definition is really uncovering and assessing what's going on in a business and trying to understand the risk involved in the investment. I always say that the single most important thing to do is to try to figure out which of those risk factors are going to be the ones that really are important for that business. We can spend all of our time focusing on, I don't know, something that has to do with customer acquisition, and this is a company where 90% of the risk is ending up in the supply chain. Or just the opposite. This is a company where if we can't get that customer acquisition machine to work, we won't be able to figure out, we won't be able to help the entrepreneurs make a go of it. And so really trying to figure out how to weight the different factors is some of the most interesting thing. Due diligence is sort of documenting the key business metrics, and that really allows other investors who haven't participated in all the nuances to be able to quickly look down and figure out, how does this feel to me in terms of my own assessment of what's going on, and that's often the reason to be in angel groups, is because you increase your effectiveness by this person nails the financials, that person digs into the market, and yet another person has talked to the references on the entrepreneurs. So it's just a great way to improve effectiveness by everybody doing a part of the job. Due diligence, when talked about in legal terms, it usually consists, and this sometimes happens, there's often two phases in venture investing in due diligence. The first phase, which is more like what we've been talking about, business assessment. And then the second phase, where the lawyers go and look at every single document. Oh, did they sign a stupid contract? Did they sign a contract where they gave away their intellectual property? Have they got a funny document in the back of some file that says that Joe Smith owns 85% of his company no matter what? Are these things legally binding, or are they just good for a nice bonfire in the center of the field? In general, what we find is that in the really early stage investing, that spending a ton of time on legal due diligence is probably not worth the money. It's probably much better to figure out a method to get into the company in a way that you understand how the team is making their decisions, so that you can be a contributor to thinking ahead. And if there is a critical contract, absolutely, it's a thing to look at, and again, maybe something that you do at the end of the business due diligence. But again, this whole idea of legal due diligence and all that, crossing T's and dotting I's, is probably less done for early stage investing.
Jean, I know in one deal that we're looking at now, one of the key issues was whether they had complied with their non-compete and if their term was over, and whether, you don't want to get into a business that's going to have some sort of sometimes there's little ones.
Yeah, there was definitely one deal that I was involved with where they actually had approached the angels, and we actually sort of knew quite a bit about them. And then the first real presentation and the incorporation of the company came on a certain date, because they had a certain number of months they had to pay out. And really, this is really a story about finding the critical factors and then making sure that as the investment use of funds gets defined, that we're talking about making sure that that matches to the goals that need to be, the things that need to be fixed to make the company more successful. So in general, due diligence starts after the company presents. How long does it take? It takes as long as it takes. certainly the angel groups, if they're acting in groups, get a really bad rap for it taking forever. And so it's one of the things to focus on is whether or not, if you know it's going to be a no, get on with it and make it a no. In general, angel groups form volunteer teams. Somebody acts as a deal lead. And most of the, pull up a chair. There's still a few more perches up on the perching place. And we have some handouts.
There's just two over in the ones. So. Thank you.
Oh, there's some over there. Oh, great. All right, so lots of groups that I see start with a 2-hour or some type of hour and a half dig into the company in more detail meeting, because you need a place where you can really sort of get the whole story, because that 10-minute pitch or 15-minute pitch never did
That's
it.
with the company, right? Where
Yeah,
you're talking with
usually what lots of groups, what I see here is that they're going to be doing an hour and 40 minutes with the company, and then have them leave, and then a bit of a discussion about what else is going on here. And at some point, you'll find, and we'll talk about this, the hey, this one's not working for us minute can happen anywhere along this entire process. Again, people who are over sensitive to the problem called it takes forever often find that by setting up weekly calls, they can keep things moving at a pace that can probably get some things done. So really, what are we going to look at? We're going to look at all of the different aspects of what is a business, and try to think about what's going to make this business successful. What are the factors for this business? You're always looking at the management team, because fundamentally, investors don't run companies. They hang around and hope that the management team does well, and that their sage advice can add some value. Figure out how big is the market opportunity, how much does it cost to get into the market, figure out if they have customers and what the prospects look like. Is this a company, all the life sciences, of course, and many other places where there's some type of unique intellectual property that will make this company even more valuable than the revenue it can achieve. Various types of competition and barriers to entry. Does the technology work? Did they write it right? Do they have a clue what they're doing? Does the business model work? If we've got financials, the company's been in business for 1.5 years, what do we know from the financial analysis, and what can we suppose going forward? And will anybody ever buy this company, or is this a company that's going to persist for a long time? We'll have to find another way of exiting our funds from it, other than an equity investment that can be harvested in an exit. So one of the things that I always like to point out is that one of the other black arts in angel investing besides diligence is the thing called, how do we value this company? Oh, is that company worth $2 million? Is that company worth $3 million? And why the heck would we think one versus the other? And so a lot of the methodologies for valuing pre-revenue companies and thinking about valuing extremely early revenue companies are all based on rating risk. And so putting various types of risk ratings around different factors are often the same ways that you're going to be thinking about, what is the value of that company. And so when you're doing diligence, you're actually doing the beginning of the process called think about how to think about the value of this company. And again, as you're valuing a company, you're also thinking about the total amount of capital it will take to move it ahead, a few other factors that are other than just risk factors, but that capital uses and ability to raise it is one of the other things. In general, I guess I like to point out that we better spend more time on the important factors than the less important factors. And and if we're co-investing with another group or another set of folks, we need to kind of know who they are. And sometimes I've helped do this presentation as a panel, and I always like to point out that my favorite is to have Boston Harbor Angels over here and Golden Seeds over there and Launchpad or somebody like that sitting in the middle, because the Launchpad folks, the Golden Seeds folks may hold up this 50-page thing and say, we put a lot of stuff in here, and so we've probably done a good job. And that may or may not be true, but they may not have focused as heavily on the highest value components. And the Boston Harbor guys, they almost all, mostly guys, will say, once we did a diligence call, we called up a reference on a CEO. Other than that, I don't think we've ever done this thing called due diligence. And then somebody else will say, hey, we finally figured out that if we didn't keep our diligence memos to 3 pages, we were already doomed because our members couldn't get through all of that complex material, and they wanted to kind of get to the core assessment fast. And then if they were interested but still needed more information on one category, maybe we've collected that and there's some place where they can go and look for that. So again, this idea of who are we co-investing with, or who is the person that produced a diligence memo is often a really important thing to think about. Okay, so we're going to try to walk through all the different factors that are on this list and talk a little bit about what we're trying to see in them. Another framework for that is the funny grid, 3-page grid thing that you have. But basically all we're trying to do here is to try to look at each of these different factors and think, well, if I'm doing early stage investing, what exactly am I trying to achieve in looking at this group and this team and everything else about them? And so we'll start with the management team. Lots and lots of experienced investors will say to you over and over again, whatever that business model said, whatever those financial projections said, they're probably going to be wrong. Somebody's going to get out, they're going to get into the beginning of getting into the market, they're going to find that it's not exactly how they thought it was going to be, and they're going to need to go someplace else. So if you've got a flexible team that brings diverse decision making together and can try to find a way to make changes as the market and what they're encountering changes, then all of a sudden that helps people kind of jump through those. There's lots of copies of everything over here if you want to.
Yeah, I think the checklist if you guys went.
Okay. Obviously, that's how they think through problems. Are they a happy team? When people apply to my accelerator, I have a team, we do a team video, and we've come up with this method where we have the 4 or so most senior people in the company introduce each other. So if I can introduce you and say, you're the best financial manager there's ever been, you can introduce somebody else and say, oops, that's the person that really knows about marketing. Somebody else can say, well, we wouldn't have the technology without this, and somebody can then reintroduce back. You can see the team dynamic in that, about a half a minute to a minute on each person, and automatically, are they having fun being together? Do they respect each other's knowledge, and do they understand the contribution given to the company as a result? And so, but figuring out a methodology to get to something like that is often a really great way to understand a company and to understand, is this team going to be able to stick together as stuff that's not that fun happens, which happens in all startups as far as I've ever seen one where it was all fun. Do they have any sense about building companies, or is it just sort of an imaginary thing? It's going to be pretty to sit in a nice office. Do they understand their category? And really, this is probably most important, and we're going to talk about this in a second. There's 2 big issues going on in due diligence. One is, what is this industry? How does this industry really work, and how can we dig into that industry in a way that we can understand it? And this is where you're trying to look into the team to have some of that expertise. What are their strengths and weaknesses? Do they know what advisors they need? Are they coachable? And so lots of times if the company can say, hey, we know that we're going to need somebody to fill this gap right here, but for the short term, we're working with this coach or maybe even a part-time person to kind of fill the gap. It expresses them understanding their need set. So market opportunity is a big issue. You know, really when we look at the difference between angel investing and classic large fund VC investing, it's all about the size of the market opportunity. Angels have figured out lots of good ways to make exits and good returns on somewhat smaller market opportunities. Whereas if you're planning to take this company to a major VC as a next or third funder, you're going to need to help understand how big really is that opportunity. And so really trying to figure out kind of what does it look like, trying to figure out how competitive is this market. Have these people actually understood their niche, and what would it look like? Again, questions anytime. I actually think that the single most likely place for a company to fail is on their market entry strategy. We've got these people, they understand the technology, they understand how the pump will work after we prime it, but they've never primed a pump. And so they just don't know how to get the process started and how to get enough things going. And the number of times that people have come to me and say, well, we don't need to know how to sell the product because we're going to use distributors. Like, come on, guys. If you can't sell the product, you can't train your distributors. So that's just sort of the simple thing. And again, increasingly as we look at so many software as a service based businesses, understanding customer acquisition metrics, and what kind of presence you have to have on the web to be a successful web company is actually really, really important.
Jean, where
Yeah.
can we learn more about that? Than seeing more SaaS-related companies? I
Yeah,
have no idea.
there's a ton of people who think they know it all and have written a lot about
Right.
SaaS. And I'm trying to think. Trying to remember the Boston VC that has a really great set of blogs on it. That he might have even pulled it together into a book. And then the other one, which is quite strange, but they really do real research, is a company called SaaS Capital. And it's one of these sort of venture debt companies that are coming in usually after angel money, but before a company is quite cresting over into a Series A level. And so we're seeing a lot of either royalty-based debt, or in other words, they collect their returns based on a percent of revenue rather than a fixed payment every month. And that allows for seasonality and other aspects to happen in terms of fitting into the market. And so one of them is called Lighter Capital, and most of them are pretty onerous. They want you to pay 5% royalties for 3 years or something silly, which if you're really growing your company, you've actually 6x paid back your debt. But SaaS Capital keeps really deep metrics on what is success in SaaS businesses and what is the right rate of customer acquisition versus churn versus other things. And so I think of them as a research house, even though they're in the side business of giving out expensive debt. And they're not as expensive as others, but they don't take the companies until they've reached a pretty high rate of revenue. So less risk. Anyhow. Business model. Not sure. This is where I'm going to, let me see if we can explain this. Yeah. I'm going to do this here. So the other thing, besides to look at really carefully, is to understand kind of what the business will be. Does it really work? What are the different components that make it fit together? And this is the other factor that comes across this entire set of activities is, well, what stage is this company really? Because if it's too early, they've got an imaginary business model, not a business model. And if it's later, they may have so underfunded different parts of the behavior of the business model that it won't be behaving right. And so stage is the other thing we're looking at the whole time. We're looking at these companies, trying to figure out if they're sort of doing the right stuff for their stage. And so really trying to figure out how things are going to work is really important. I sometimes try to get the entrepreneurs, and this is actually a good due diligence activity for the investors too, is to on one piece of paper tell me the factors of your revenue, and on another tell me the factors of your costs. And don't give me a 25-page spreadsheet with that's all interlinked with a big pile of assumptions out front, because you don't understand it and you can't explain to me how it works. So just show me these two, maybe 7 lines each, factors of what's happening there. And then what usually turns out is that hiding underneath the revenue side of that simple model of how it all works is that they don't really know exactly what it takes to sell, and so really trying to figure that out. So again, try to get people to get real about how they talk about these things. If you're crazy like me and you're going to invest in early stage companies, you'll find that you'll have to have sort of a grain of salt that you're putting on some of these documents. And if you're a little more rational and wait till they've started to really execute, then you can get some of the risk out of this part of the model.
Jean, question. So that's a good segue into stage a company where you do jump in as an angel investor, right? You were talking about diligence after, but as far as the timing of when angels come in and give money to these companies, it's fairly early in the process. And so how are these companies going to be able to really tell you sources of revenue at this point, when they may be pre-revenue or they may be early in that revenue stream?
Yeah, well, I think that's right. I mean, I think that we see lots of companies that are pre-revenue, but can truly describe where the money's going to come from. They know about what the price point is. They've been out and talked to people. I always say to people, maybe you're a pre-revenue company, but if you as an entrepreneur have gone out and talked to 20 of your future customers, and you're able to come back and tell your angel group, hey, I talked to the 20 people with this job title in this kind of company, and 12 of them said they were interested in my product, and 6 of them said they would consider being my beta, and 4 of them have actually signed up for my beta. And the last time I talked to the VP of XYZ for DuPont, he or she said blank. Then you're able to have a discussion with your potential investor that is a pre-revenue discussion, but it's based on doing the research, going out and talking, figuring it out. And so again, there's no right answer. And in fact, one of the things that I would say is that both people as an individual and groups as a group need to find their comfort place for risk around stage. And I don't know any way to describe it. It's like when it comes time to write the second check, you just absolutely know. And so again, I would just sort of urge people to listen to themselves, because if you're unhappy, you shouldn't do this. You should always be happy. And again, but stage is where all these risk factors are, you know, humongous pile of risk factors, a few that have melted, a few more that have melted, and then finally we're starting to be able to see something that looks like, you know, how it will actually work. And so so no real easy way to describe that.
So going back to the business model for a minute, in my experience, if you ask, you know, 10 different entrepreneurs to describe their business model, you're going to get answers that are all over the board. There's not a real solid understanding of what it even means to describe a business model. I think that's gotten better over the last 5 or 8 years, but I guess number one, is that still what we should expect? That there's you know, as long as they can kind of talk some good game in some arena, that's acceptable, or has it kind of converged to where there's a better expectation of what kind of answer one would get when one asks about a business model?
Yeah, I'm not sure it's converged. I do think that people have read the books that say, hey, you should be able to, you know, kind of do what I just said, have a description of where the revenue will come from, what size of chunks it comes from, how many customers it takes to achieve that, and then another page that at least has the basics of your cost structure across the next couple months. Sometimes they know enormous detail on the cost, right? They want to tell you about the paper clips they're going to buy and how much it costs to park. And you have to stop them and say, no, I can't look at that. You have to give me real things that matter. So I don't know the answer to that. I do think that you can point people to a couple of different places where both the testing of the market and the writing down of the core, really basic financial model exists. Try to think of which is the best one. One that I'm thinking of right this second is Bill Olet from MIT's book, which is particularly good on describing to the entrepreneurs how to go out and test the market and retest the market and realize that it's an iterative process and that it probably will never end. Not sure about that.
And Jean, I know that one of the things that Maine Angels tends to do is to really look at the assumptions behind those revenues when they're pre-revenue projections, like, well, what are you basing that on, and where did you pull that number from? And have you gone out and done customer discovery? Are you basing on what other is happening in the market, or what's your competition priced at? And not that I am great at that, but again, it's that group discovery of like trying to say, this doesn't sit well with what I'm thinking it should be, or you cut it in half because you know that they're just sort of grabbing the pie and stuff.
Yeah, well, and again, I think this problem, you know, I think I already said that it's industry and stage are two things that we're juggling like crazy as we look at these early stage companies and understand what really does and doesn't work in a particular industry. And that shows up in the assumptions, but you also want them to go ahead and write it down so that they actually have something they're supposed to be responsible for. Because they can give you a pile of assumptions. Actually, we will talk a little bit more about customers in a second, because I think it's another important category. Are there patents? Have they made a proposal? Do they know the difference between a provisional and something else? If it's really the entire core of the company, you may need to make sure that you get them reviewed somehow. I've actually found that the best way to find out about the IP in a company is to ask to do not have to sign any kind of non-disclosure or anything like that, but instead ask to interview in a non-disclosure kind of way their IP attorney. And write down a pile of questions that are going to help you ask their IP attorney, well, why do you think this works? And have you checked for these kinds of issues? And particularly if they've been in the business any length of time at all, the IP attorney will tell you, this is a patent that has 7 claims, 2 of them are going to stand, and here's why I think that. And they won't say it like that, they'll say it in legal speak. conditional clauses. But you can figure out what they're saying, and it's often a lot cheaper than trying to figure out how to find the actual expert that understands some weird category that's really hard to dig into.
Yeah, I just have a question on that. So the attorneys, he owes his allegiance to the client.
Yeah,
When did you become the client?
you're never the client of
Yeah,
that attorney.
That's
You're-
right.
Yeah, if it's so important that you have to do a full IP review, you'll have another attorney or somebody like that doing it. I've had very junior employees working for me go out and read the patent history of certain categories and other things and produce reports with some coaching from some IP attorneys. But most of the time you don't need to go to that depth.
I mean,
Every
will
so often
the
you do.
attorneys speak that frankly to you?
Well,
That
they'll
they will tell you that
they'll
certain
tell you
claims will
something
not stand.
factual, like there are 7 claims in this, in
Yeah.
this patent. And then eventually, after they warm up a bit and you've talked to them a little bit more about, have you seen any motion from, I don't know, Hewlett Packard in this category, whatever it is, then they'll find a way to say, I think 1 or 2 more really important are.
Okay.
And again, these are these companies that do have an IP core, and you can also ask that the entrepreneur introduce you to somebody else in the field that they feel could talk about the category. And I find it's not. I don't know how to say this. I find that with a little bit of snooping around through the angel community, you can find somebody who's able to hold a pretty good conversation and say, yeah, that passes the sniff test over to this level on lots of different parts of technology. And I also think that for the amount of money that's going in the first angel investment, that if it's a company that's highly, highly dependent on a phenomenal IP component, that and it's a big deal. I mean, in other words, we do have a cure for cancer, or we do have a important discovery, that the next funding is going to do a much deeper investigation. And so you're taking a time-based risk, and your decision on whether to follow on the next round could be based on the behavior of that next investor. So again, IP-based companies have a much higher likelihood of going into the VC community, or even attracting strategic investment from large corporate players. And so the behavior of that next player is actually a huge indicator to you. And again, you are at risk for that first money, but again, it may not be, you may want to load up on the second or third round if it really is an important thing.
Can I make just a quick comment
Yeah.
on that? I mean, a really basic thing in terms of IP due diligence is it's really easy to look at the claims, forget all the other stuff, look at the claims, and just say, does this even cover what their product does at all?
Yeah,
Because
that's
sometimes,
right.
yeah,
Absolutely.
they may say, we have 6 patents filed, but their product may be, a new material to do something, and the patents are, processes to do something. And so just because they have patents, one key and easy question, you don't need an IP attorney, at
Yeah.
least not for the first cut at it, is, does this even relate to the
That's
product
right.
that they're selling?
Read it, read the claims, spend a little bit of time in there, or find the really smart student in the category that will spend a little bit of time in there, maybe directed by somebody who knows something. Yep.
If a company is raising in between the provisional and the patent being granted, and they're going to earmark some of the funding to finish the legal process to have the patent granted, is that funding the evaluation of the company?
Well, unless it really is an important discovery, I find that the patent protection has the biggest impact on being a road bump for other major corporations not to step on. But if it really is an important discovery, the finalizing of the patent and then the issuing of it we are in a value creation stage across those stages. So yeah, a little bit that's true. You sometimes find the people that are just in love with their patents, and so they're spending all the money protecting this huge array of patents, and when you sit down with them and say, what is this worth? And they go, well, it's not worth anything, it's personal to me. You go, let's get this out of the company and back to you, and let's keep it in the company, but you're gonna pay for it if we're gonna protect it going forward. And, you know, again, it gets expensive when you're out in multiple countries, right? Oh, Japan and Brazil, and what else do we need? Traditionally, I thought we shouldn't bother for China, but apparently the world's changing according to the news today. Who knows? Technology assessment, you know, is it really different? Is it disruptive? Is it a science experiment? Is it a product feature? Is it something that should be bolted onto something else? One of the things that lots of different investor groups do is to use the chief technical officers of the, chief technical officers of other companies they've invested in to take a look at the technology. It often works out really well. You know, again, this market entry and the competition are really hard to do, but you know, just a little bit of work on the web and you can find out a ton of stuff. You just type in all those keywords and bam, it all comes out. And you know, somebody sends me this thing and they go, well, blah, 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 worth $1 gazillion. And I'm like, worth $1 gazillion, but we're only gonna have, I don't know, whatever it was, $50 million of revenue in 6 years. And I'm like, you know, 10 seconds on the web, this is a competitor for melatonin, for travel disruption, and melatonin's already a $1 billion industry. Just a minute, how can we only be at $50 million in 6 years after absorbing $50 million of investment? Either there's a business here or there isn't. So, you know, 10 seconds on the web, you can go bam, doesn't make any sense. So figure out what's out there, figure out who the other players are, figure out if it's incredibly important to them. The financials. Well, this is another place where sometimes we're looking at quite imaginary things and sometimes we're looking at things that are very carefully done. And so, again, really understanding both the backward-looking financials and the forward-looking plan, very important. You got to get to the cap table pretty early on, so again, if you can get people over there. Figure out if there's various types of payables and bank debt, and figure out how they're going to be taken care of as the deal goes forward. I lots of times spend the bulk of my time thinking about investment, thinking, well, if this round is 350, and the next one we're able to take it maybe to angel group syndication, we're going to see $1 million, maybe $1.5 million, and then how much more? And if you're thinking about the total capital required, you're starting to have a real dialogue that drives into understanding what will be the state of the company when we get to an exit. You know, given that the entrepreneur has put in 17 different imaginary products being sold after the one that they actually know, then sometimes you have to discount their revenue projections a bit. But I have to say, when I talk to women entrepreneurs, one of the things that I often say is that we have a high tendency from the woman entrepreneur to see the business plan that's about the business that she actually knows. And she knows what it looks like, and she's written down pretty carefully what she thinks it looks like. And so when I'm talking to the entrepreneurs, you guys are the investor side, but I would probably be saying, you know, when you're competing for capital, you may tell this story and be absolutely truthful about it, but your competitor for capital, who might be male, might say, me and my brilliant team will be adding another product to our product line at month 14. And so not only do we have this business, but we've got this business, and here's the services business that goes with it. And so they're projecting something to the investors that's about confidence and about future lines of business that's different from the core line of business. And so, again, you guys need to take that with its own grain of salt, because some of these add-ons over here may be 100% imaginary, but on the other hand, they may be an example of a great company that understands that there's more than one line of business in the business they're describing to. Exits. I don't know. I think that it's awesome to have a lot of conversation about exit, but I also think that the best, in my experience, the best time to have it is about a year or so later. Because if for some reason the entrepreneur thinks they need to spend all of their time talking about exits, they'll really, they have to grow a business before we ever have this part of the conversation. On the other hand, after you've been with them for a year, 2 years, 3 years, they should be able to give you a really detailed understanding of why they fit into the market someplace and what it would look like.
So isn't an appropriate question at that stage, when we're thinking about investing, about exits, to just simply, is there likely to be one at all?
Yeah.
Or is this a lifestyle company?
Yeah, I think that's right, because if we're going to have to get our returns back out of something, dividends or other types of repayment provisions, we better know that. And again, I think sometimes companies end up encountering a market a little different than they thought they would. In other words, I think there's some really good companies that are highly profitable, but do have characteristics of, I don't want to call them local monopoly, but they have good characteristics for being a great regional player, but their ability to scale and drive into a gigantic market is often quite hard. And I don't think that all of those companies should be out of our angel investing portfolio, and particularly if we care about some things that look a little bit more like impact than other things. So again, I think we need to think that through, but we should have the discussion, and then we should revisit the discussion. In fact, I'm a big fan of the once a year so-called board retreat meeting, a longer board meeting where you actually, put 2 or 3 things on the agenda that maybe the first year they're just on there because we're trying to pretend that we're going to talk about them. And then the second year we really talk about it, and then by the third year we actually get a real plan and build it out. So customers are actually a really interesting thing. If a company has customers, and we call the customers the first day that we start talking to the company, and then we later don't invest, we've probably done a bad thing for this company. And so I actually say to the entrepreneurs, hey, your customers are the last thing you give. Remember, this is a process. You're getting to know people, they're getting to know you, but you don't really want to, invite them home to meet mama or whatever the equivalent of giving out the customer list and contacts are. So they should be able to describe to you the kind of customer they are. They should be able to show you the time they spent in the funnel to get to being a customer or to being a highly likely prospect that we're going to close any minute. But then your request to actually call them should come very late after you're pretty sure the deal's going to go ahead. So they should be talking about the funnel from day one, helping you understand the time that it will take to move things through the funnel, but they probably should not have to allow you to call up too early. And then you need to be careful. Hey, I'm with a group, we're thinking about some investing, but we're also, there's some resources around our town that can help smaller companies. Sometimes they want to help you craft how small you describe them, because they've managed to convince their customers they're a little bigger than they actually are. So, and then again, eventually you'll be trying to figure out, are we on the before crossing the chasm part of the world, or is this an example of a company that is starting to get across a chasm and we can actually see what those customers look like and the ability to repeat with similar types of customers. And so again, that helps you understand the total amount of capital that will be taken, et cetera, and may help you keep the amount of investment down during the period that they still have to figure out the crossing the chasm method and a few other things like that. Anyhow, so we've done all this diligence, we better write it up.
Jean, I'm wondering with the interviewing people, when and how you reach out to people who weren't recommended for the companies.
Oh yeah, well back on team I should have said, right early on, you should do backdoor reference checking on the people. And everybody's got somebody that pissed off somewhere in their life, particularly if they're arrogant enough to be an entrepreneur, yay. But you shouldn't find a big pile of really messy stuff. And so a little bit of backdoor references as well as some personal references, and those should all be sort of coming along. So as you're talking to them about the team and how are they filling in the gaps in the team, you know, you'll be saying to them, hey, one of the things that we'll be needing for you, you know, about week 5 of this process, if it ends up being a, you know, 7-week process, or week 3 if it's a 4-week process, is going to be your reference list. So, you know, be ready for us. And then you're also doing backdoor checking on them. I don't think you're trying to cross-check them on customers. It's just too messy. But you are doing quite a bit of checking all the way through. So we're going to write it up. So one of the things that I have for you is the outline that one of the groups in the region uses, and this is the one that says XXX group at the top. Not sure if it did or didn't go out. And so really this is pretty simple. This group uses 3 pluses, 3 minuses, or a 0 on each of the risk factors. And so what they're trying to do is they're trying to say, for each of these categories that we're looking at, is this 3 pluses, or is this 2 pluses? Is this a minus? And I think what it does is it helps. It's just a concrete way to try to think about how are we going to share some information about what we think about this company. And here's some crazy photocopying here. But again, this idea that on each of a bunch of different factors, you're trying to say something about the company and put it in a format that can be read. So again, I think that this particular angel group that uses this form, they try to keep their memos to 3 to 4 pages, and so so each of these is going to be 2 paragraphs, but it's not going to be 4 pages. It's going to be something that tries to get to the core factors pretty fast. And so here we are. We've screened and selected companies. We've had them present, and then we've decided that we're going to go ahead into due diligence. So, or we're going to decide no. Now we've done our deep dive and our diligence, and we're getting ready to write this whole thing up, and we're looking at how risky it is. And oh my goodness, we have a whole lot more minuses than we have pluses. Does it fit the team that's been working on its feeling that it's safe enough to proceed? And B, is it going to work for the rest of the group as we bring it back? And so, again, we're reviewing the risk factors as we go through all of this. Now we're going to craft the deal. We're going to figure out if we can come to a good pricing range. Actually, some amount of deal crafting is happening usually as all of this is pulling together. You're getting close to that close. Then we're going to finally let the lawyers spend a lot of money and make us some beautiful documents, and then we're going to have a close. And then we're going to try to monitor the investment to reduce risks. Oops, I bet we're going to need another round. So all the way across here, you're in a mix of sort of thinking about the diligence, thinking about the risk factors, and thinking about how to weight them. And so really, diligence is just trying to be a rational way to assess risk. The goal is not to find the company wrong, but to agree with the company. This is important. This needs to be fixed. This is hard to fix. And so our risk-adjusted price is lower in terms of our cost of our shares. And then finding the most critical factors so that the valuation can be agreed on, the company can be reviewed by co-investors, And importantly, the use of funds can be allocated to risk reduction. That's what we're trying to do in this whole thing, is say, hey, we've raised $350,000, or we've raised $50,000, whatever it is. What will change the risk factor for this company going forward? Where should we spend the money? Should we finish on the technology and building out the product? Shall we put some sales and marketing dollars in? What are the things that are going to demonstrate to us that it's going forward?
Gina, is that actually written down, that agreement? I agree, that's a key point, but is that just discussed and you sort of believe that they're gonna try to do those things unless something else comes up, or is it actually formally agreed on?
Yeah, so a use of funds statement is, so lots of times the company, when they come in to present the first time, they say, we're trying to raise this much money, and this is what we want to use the funds for. And then if you've actually had a great diligence process and you and the company are now seeing the world in similar framework, many of them will say, yeah, let's rewrite that page on how the funds will be used, because we want to do this. And then we want you to support us to go out and present to these other groups around the region. And we want to be able to say, hey, we worked out this use of funds statement with our lead investor, because that makes us be able to describe how we're going to work together with common goals. And so if you've had a great process, that's the magic, is when that's what you're both saying. I'm not going to go here, it's about pricing. This is me saying what I've just said to you again. Goals alignment. We're not trying to find mistakes, but agree what would be important to fix, what would be important to focus on. How are we going to make sure that our focus matches up with where we think are the risk factors that are going to be really making a difference as we get through this. This is an example of a sample board dashboard where, maybe we're in good shape around something, and maybe we're not. And are we spending our money and our time, including our time at the board meeting, focused on the things that are the most important? And so again, negotiating the metrics that we're going to keep with the company in terms of sort of a dashboard way of thinking about what's important to us at the first meeting after in time for the first board meeting after the funding is a great way to reinforce that agreement about what are we spending our money on, what are we spending our time on. And again, one of the things about a board meeting is time is money. If they regurgitate status on all the things that are going well and you didn't ever get to the important and risky things, you wasted going to that board meeting. So again, just help the company get focused on, we're all trying to grow this thing together. So we're really good at doing syndication between angels in New England, and so it's really, we can't do it if people don't do diligence, because we need a way of shortening the amount of time that each group spends coming up to speed on a company, and the best way to do that is with a written diligence memo, ideally not so long that it can't be read. So the details of the business, the riskiness of the investment, helps everybody figure out if it's fun. Lots of times there's really neat things to dig into, that market size, that how did we think about the sales process, or whatever the different things, and when we're in agreement with the entrepreneurs on the critical success factors, we've actually done what we set out to do. I think I've overrun my time. I thought I was going to be short, but I'm
You are okay. We had planned to run until 6:15, so.
So this is the great Q&A time. Yeah.
What do you mean by syndication between the angel groups? You just mean that they share information?
Yeah.
Okay. So
So there's the reason why there's all these silly words on the top and the bottom of this memo document is because by making all these claims that this is not something that we're acting like an investment advisor to you, we're just telling you what we found. You're on your own, good luck. But the reason for all those words is because that matches with what the most of the groups in New England have signed as sort of a class of deal sharing memo that allows us to really quickly, some groups like it have it re-signed on a per deal basis, but let's not go there. But really quickly be able to share deals all over New England.
And this, the website Angel Treaty?
Yeah, well, angeltreaty.com is where it used to be. I'd have to go check and see if it's still there.
It's basically if Jean supplies me with a deal memo and the deal goes south, I'm not able, the treaty says, I'm not gonna go back and sue her, like, oh, you misled me. My responsibility is to read her deal memo, and if I have other questions or other concerns,
Right.
I then need to go and do my own, or our group does. But it's a way that if, like, Maine Angels, we're not able to raise $1 million to help out an entrepreneur. But we may do the initial diligence and do 250, and then we may go to, the Angel Capital Association Summit and say, we're looking for $750,000. Anybody else interested? Her group might say, I'd be interested to take a look at it. You might say, oh, I'm involved. They want to know somebody who knows that entrepreneur and has dug deep, and that we're willing to share. These are our concerns. Here's where we think it's great. This is where we think we got to mitigate. Does anybody in your group have this kind of expertise to help us out?
So is that typically where the syndication connection is made? Or like if an entrepreneur comes and is pitching a group I'm in, but he or she has also been out pitching other groups and has other investors, does the entrepreneur put my group in touch with them to get the due diligence, or how does that work?
I think it varies. I mean, if it's
All over the
a
map.
Boston entrepreneur coming to me, our group, if they don't have a local Boston group that has been their deal lead, we're not gonna look at them.
But do
Because
they
if they
tell?
can't raise money in
Well,
Boston,
I
they
think there's two things. The entrepreneurs are sometimes hesitant to bring the investors together too early because they think, ooh, this person is giving us slightly better terms than that person. And so the entrepreneurs sometimes are trying to do a little bit of dance. Later, when they get real and they want to just get enough money, they're probably less interested in that, but they don't really have great expertise for it. But usually after you get a ways into here, they'll say, here's my list of other potential investors, and if you're developing a rapport with them, you can say, would you like me to contact them and see if they want to share diligence with us, and sometimes we'll have these phone calls and somebody say, yeah, I'm representing the XYZ group, and I'm representing another group, and I'm representing another group. We're going to take care of the financial model, and somebody else is looking into the intellectual property. And so sometimes we see people working together. More frequently, we tend to see a group be the core lead, and other people kind of add on, or just even listen to the weekly phone calls and be invited to the Diligence Dropbox or wherever we're putting the documents that are being collected.
So in the situation you described, if you've already agreed to commit, $50,000 or whatever it is, so you already have valued the company and you've come up with deal terms, if you're then out sort of helping them shop that deal to your peer investor groups, are those other groups going to get the same deal terms, or are they going to negotiate?
Absolutely. It's illegal for an entrepreneur to have more than one set of terms in the market at a time.
Okay.
And we have seen the instance where somebody said, hey, I got this group to give me this valuation, and then they've come back and said, I can't get this other group to move unless we drop it a little bit. Isn't that okay with you? And you go, oh yeah, that's okay. And so again, it's sometimes they're out doing the shopping around. Sometimes it is very efficient once you know each other to just be able to say, hey, we think this one might be a fit. Would you like to look at the presentation deck and see if your crowd would warm to this? Because again, different crowds have shared risk factor, and that you're happy in a group when you and your group have a same sense of risk. You know, no, we don't do those kind of life science things, they're just plain scary. Or, yeah, we love to work with early stage companies because our members love to get involved and hands-on and really help. And each group is different and each set of people are different, and so you start to get to know a little bit who's there.
I also think that sometimes if entrepreneur is the one who has to be out shopping their deal, so to speak, it means that they haven't been able to get somebody who's really willing to champion their deal. And, because it's a lot of work to pull all that together if it's just one or two people. So like, I know there's several angel groups who say if we can't get a minimum of 3 to 5 people, or a minimum
6
of
people.
soft circle of at least, a certain dollar amount, whether it be $50,000 or $100,000, we're not even gonna go into this process.
Yeah, and the bigger the groups are, like Launchpad and Golden Seeds are both big groups, and they tend to go later and do larger amounts of money because it just fits with their process and fits with when they do things.
Do you always consider, like if you're in round 1, do you always consider, oh, there's gonna be a 2 and a 3? Do you always just think that ahead of time, okay, I gotta keep some of my powder dry because in order to hold on to the percentage of the company that I originally signed up for, I'm gonna have to go to 2 and 3?
Yeah, well, 2 or 3 different things. Yes, there's always a follow-on round in most angel deals where we're being successful. Because we just never got it right. We just never got the total amount in the first round. And so keeping dry powder for 1 to 2 rounds is the norm. And some people make cases for quite a bit of money in dry powder. I in fact, some people are trying to load up their winners. Hey, I want to put more and more money in here. And other people are trying to follow that. I want to keep my percentage the same, that pro rata kind, it's usually described as pro rata view. And then I often think, oh, I'd rather have a higher percent of the shares that I bought be the 20-cent shares, and a smaller percent of the shares I bought be the 60-cent shares. So I'm probably going to taper down as we get going, unless I really, really think it's a win that I should be, putting a little bit more into. So everybody does it different, and there's no right answer. But yes, there will be another round.
So is it 3 rounds? Is it 10 rounds?
No, and that gets back to one of the things I said in there is trying to, at some point in the financial modeling of the company, to start to build
How much do they need?
a sense of the total capital required to get to, at least break even and some kind of growth, company funded growth where the revenues fund the growth. They may still take some money at that point because they can grow faster, but they're out of the woods and they don't need the whatever.
And just to follow on that point, is it useful or productive in round 1 to be kind of targeting or committing to round 2 under certain scenarios, and can you build that in so you can
Milestones are
protect
really
your
great.
back?
Milestones are great. We don't tend to see them built into the legal documents because they're too hard to enforce. I do remember there's one chemistry company called Callion that Cherry Stone led, and they put in a really low price, but they said if you hit one of these 2 milestones, we will promise to bring at least this much money into the second round at this price. And the company was a little late on its milestone, but it did hit its milestone and they did deliver. And it's now quite a valuable company. And so, and again, they got away with a really low price for the first price. And it was partly because it was still sort of a science experiment. And so, there's no right answer to that, but in your mind, you should think, I need to have money set aside. And then kind of like the thing there that you may decide, I'm not feeling that good about the direction they're going in, or, that new VP of sales, I think that's that's making my bullshit detector go off. I just really am not feeling great about this. And so, so I don't think there's any right answer for how much to follow on, but in general, if you want to have a good return on your investment, you should expect some follow on. And the companies need it. I mean, in fact, one of the greatest things about the angel community is that there's a pretty high tendency for follow on, and so you sort of say, hey, we found 3 new people who didn't invest last time, but they want to come in now, or and then these 2 people who dropped out, that's okay too. And so we have a high tendency to be pretty loyal followers. So I think it's a good story.
Can you talk a little bit more about that balancing act, though, with if a company needs to extend around or something like that, because they did something didn't quite work out as planned. That idea of, well, let's follow on to keep them in business so they can get up
Yeah.
here. Is it just you?
Yeah, well, again, I think maybe I said the last time I talked to you guys that the only time I've really lost money is when I kept writing bad money after bad, right? So that dream that somehow we're going to get better is quite dangerous. And so having a little bit of gut in there is a, just won't work, it won't fix. But I think the biggest truism people say about angel investing is it takes longer and it takes more money than we imagined. So even though we scrubbed the assumptions with the entrepreneur and it all made perfect sense, it just took a little longer. Something didn't get done in time, something didn't work. That customer had a change in senior management, and that big deal didn't come through when we thought it would. And so, and we see a lot of people coming out and saying, hey, we hit most of our milestones we told you we were going to do with this funding, but we don't really think we're ready for, bringing in a pile of new investors or maybe hitting the imaginary Series A level. But what we do think is that we've hit some of them, so what we've done is, even though it's kind of in the venture community, the idea was that you wouldn't reinvest in your own company, you would try to get some outsider to price it so that then your money wouldn't be sort of self-serving and again, the investor, of course, always wants the price down. Hey, you didn't accomplish very many milestones, and the entrepreneur, oh, we accomplished a lot. So sometimes we'll see people going out and saying, hey, we're going to put the exact same term sheet out, costs us no money to create the term sheet, but we've agreed to a 10% increase in price. So instead of, 30 cents, we're going to be out at 33 cents a share, and we're finding lots of interest at that price. And so, and again, it's a way to keep the price down because you didn't change the deal at all, except for just the price. The money you spent on legal documents didn't have to be recreated. So we see a lot of that kind of behavior. Either I put it right back out at the same price, or I put it out with a small uptick.
And I think that sometimes, particularly at Main Angels, there'll be people that are looking at it in the second round saying, oh, well, if you were looking at it now and I'm the first time going in, would you invest again? I mean, would you look at it as a brand new investment? Would you invest in it? And I think that keeps you from kind of putting money in because you're just desperately thinking, oh, they're just around the edge. They're just going to make it. They're just, and when you're like after 5 years in and you're still doing that, it's maybe you want to reevaluate everything in that.
Yeah, you should have a meeting with your investment committee in the mirror and decide that you're crazy.
Is that like being in Vegas and trying to get back the money?
Sometimes you get overly attached, or the entrepreneur, or you've been with them so long, and you just thought it was such a great product to begin with, and of course it should work. And it's like sometimes the metrics or just the market or whatever, it's going to be the living dead. And you've got to decide that's not a good place to put your money. There's other places that would be more productive for you.
And usually by the time you get there, the entrepreneur knows it too. They're just scared to admit it to themselves.
Yeah.
I have a question. With some of the uncertainty in the regulatory areas, Do you see how that might influence how people would do due diligence differently, or just look in certain sectors? I mean, you look along clean energy, you look along, for instance, that's an area.
Yeah, well, you know, again, I think every industry has a lot of risk, and regulatory risk is clearly one of the risks. In general, I just think you need to weigh it into the total picture. Some types of regulation are not, how do I describe it? Don't define whether the business model will or won't work. What they sometimes do is they limit the cost of getting into the market, and so again, you're looking at sort of the total amount of capital needed more than some other things. But again, I agree. We definitely live in strange times, so who knows what the world will turn out looking like.
Thank you.
I know you skipped over this one slide, the risk factor for summation methods that actually had numbers on it about evaluating a company. You know the one I mean?
Yeah. So basically the whole idea here is that there's been a bunch of different methodologies created for how would we start to think about pricing a deal that doesn't have any revenue. And two people have published different methods that are risk-based, putting risk factors on, and either pluses or minus of up to $500,000 of valuation in the price. And one of them, that one that's on the page there, they said, hey, we're always going to start with the base price of a company being $1.75 million. Not sure why. And then we're going to add these numbers on. And what it does is it ends up with your most likely angel-worthy investment deal coming into a price point south of $3 million, but north of $2 million. And that actually is New England pricing. That's Yankee pricing. Now, if you're in California, we just add $1 million, and we don't know why, but we just would. And so I don't think there's any right or wrong answer to it. And again, this is one of the hard things to do for brand new angels. And again, one of the reasons to have a few, old gray hairs around to sort of help with the valuation part of these. And really, at the end of the day, valuation is about what will the market pay. And so if you're looking at it and saying, me and my angel group putting this blank, let's say we got up to $300K, whatever it was, and we're going to own 15% of this company as a result of doing that. And that feels pretty good to us. We feel like we've got, sort of a risk-adjusted price for ourselves happening here. And so again, I didn't spend time in this conversation on, either how to get to those numbers. I've got some slides I can send you if you love it. I think it's crazy, but it's black art. And then the other thing is, but again, you'll be making a decision based on that. And you and your group need to agree to kind of what makes sense to us. And part of the reason why we price low in New England is because we want that next round that we go out for. We priced this company at $2.2 million. We raised $500,000. Now we've got a paper valuation of 2.7. We don't want to do a cram down, and now the company is probably 2.7 worthy. Whereas if we had priced them at 2.7, we're getting into the above threes, and then people are going, how am I going to make my return? And so again, it's part of the machinery of making the whole system work. And luckily we live in New England, so we get to do Yankee pricing, and the investors who live here will come to love us for it because we help them get their next round easier.
And I actually think it's one of the advantages of the Angel Capital Association, the ACA, is that they do collect a lot of metrics. And when they come back and keep saying again and again and again that the sort of pricing range that seems to be coming in is 2.5 for early stage investments, and somebody's coming to you and saying, my company's worth $5 million, and you're like, on what basis? You're pre-revenue. I mean, you
Well,
know,
again, if you look at people who've been through Y Combinator and are located in San Francisco, you know, the average price is completely different. And so if they have a fancy law firm that's searching out the venture-based first seed price, it's a completely different thing than what you'll see in deals that are going to be very recommended across you. I think we're going to have to go get that wine pretty soon, but I'm happy to do a few more questions, but I'll try to do them quick.
How much time, I mean, on average, obviously, between the first round and the second round?
So the old VC norm was that we should be raising enough money to last for 2 years and to come back and ask for it at 18 months. And that just doesn't happen because there's just not enough capital. So, but again, if there was enough capital always, we'd probably try to help the companies get there because they get their valuation steps up in a way that helped them maintain a good amount of control and helped us get good deals. I'd say that most of the time we're looking at companies that need to be back out between 14 and 18 months, and they may need to close the follow-on money. And so one of the disciplines, of course, is to have everybody start tightening their belts at month 12 and tighten down. And other times we see the revenue kick in and we're going groovy all the way up through 2.5 years before we raise again. But it definitely, I would probably say that particularly if we're going to be gutsy enough to be in the early stage deals, that we should start to think in, you know, will this company be alive and hit some milestones in 12, 13, 14 months that will allow them to be able to close up some additional money in 16, 17 months. And yeah.
Before we break, I do want to say thank you so very much.
Thank you very much.
Coming back. We wouldn't be able to do this without you. You came up for the first event in November back in Portsmouth, and it was a tremendous first event. We had the last webinar that you led with 2 other panels, and then this training event. It's really great for us to be able to bring the women of New Hampshire, Vermont, and Maine together, whether in person or through our webinar series, to be able to continue the conversations, to network with each other, and to learn together as a cohort.
And there's lots of other great sources, so don't just think that and believe me, I'm so excited that we're getting more and more women angel investors.
Right.
That's why we love you, Jean.
I know the excitement that you just bring to us at the time too is wonderful.
Yay.
You have some and I have some.
Yes, I have to climb back down.
Okay.
Yes,
All right, so Jean has been great. This is the 3rd time she's come up. She is really, she's enthusiastic, as you see. She's been training and very passionate about trying to bring more people to feel knowledgeable and comfortable and understand what's going on. So I brought you a bottle of wine. And what's really kind of clever about it, when I told her, I said, well, I have these like funky bottles of wine that on the label, they say Angel Reserve and there's wings on the, so I want you to have this as a thank you for coming out.